Hello startup community and welcome to a new episode of How to Start Up. Today's episode is about how to raise capital for your company. So, get ready to take notes. Hope you enjoy the video. Raising funds for a project is a ubiquitous subject in the startup industry. Cash is the fuel of any company. A company running low on cash is jeopardizing its operation, or even worse, might be facing its end. In the case of startups, not having enough cash may be the cause for not starting at all. Hence, this step is crucial, as it will determine whether a project might come alive or not. It is also one of the most difficult tasks for unexperienced entrepreneurs, which in many cases lead to giving up their projects at an early stage. Today, many options are offered to startups to take care of the financing. You should examine very closely different variables about your company to determine which financing channel you should pursue. Picking the wrong channel might hurt your company and waste you a lot of time. We will explore in detail the different options to raise funds for your startup, as well as compare the benefits and pitfalls of each of them, so that you can make an informed decision and save a lot of time. After watching this video, you should be able to determine what channel works best for you. The first channel we will explore is venture capitals. This is where large investments come in. VC, or venture capitals, are institutions that usually fund companies they judge will have a large return on investment. They generally fund the project against a portion of the company called equity. These companies are more interested in exits. Example, your company being acquired by a larger group or an initial public offering. So they are here for the long term. Venture capital can provide a dedicated team to support and bolster your organization and can interfere in the management of the company. So, if your company is valued at $5 million and you are looking to raise $500,000, then you will have to issue 10% of your company to the VC. Basically, this is one way to determine the percentage of equity you will be giving. One thing to keep in mind is that VC usually invest in companies that already produce revenues and not so much on initial phases of startups. They are also looking for a return on investments in a range of 3 to 5 years. So if your company expects to break even longer, then a venture capital might not be so much interested. The typical profile of VC is large, stable investments, a solid team with a robust background in the field and a certain number of existing clients. To summarize, venture capitals are institutions that invest in established companies producing revenues, stable structures, which have 3 to 5 years of existence. If your company does not meet these criteria, venture capitals might not be what you should be seeking. Now let's look at the next source of financing: investment angels. This type of investment is definitely worth exploring. Angels, as opposed to VC, are wealthy individuals interested in high return on investment projects. These types of people take on more risk, but expect a higher reward investment. Angel investments usually represent a smaller amount of investments compared to venture capitals, but might be more flexible in the management of your startup. An interesting aspect about investment angels is that they can invest in early-stage startup projects. These types of investors usually are found through word of mouth. The Middle East, for instance, is a hub of high-end investors that regularly fund new projects. If you believe your project or your idea needs a little work before being presented to investment angels or VCs, it might be wiser to invest some personal funds into the project first. This is referred to as bootstrapping or self-funding. When starting a new business, it is quite often difficult to get the trust from investors to finance your projects at such an early stage. Intuitively, investors like to see some traction and a solid product before investing a buck. They must evaluate the potential success of your project and ultimately their own return on investment. One option would be to save money or invite your friends and family to support your projects financially. One advantage of this type of fundraise is the lack of formalities and the already built personal trust. Self-funding can give you the trust from investor in the following rounds of financing. It conveys a clear message that you are confident enough about your idea, that you invested your own money including your family and friends. This method is usually used when the financing required is small enough that you can pay out of pocket. Another advantage of bootstrapping is that you will be more careful with your expenses. This will teach you how to properly manage your finances when more investments come in. If you are looking for mentorship and advisory, along with financing, then you might want to look into incubators and accelerators. These organisms, almost found in all major cities, are specialized in guiding entrepreneurs structure their projects as well as bring some initial fund to support the development. These programs usually last 4 to 8 months. They take you under their wings and provide you with a team of advisors and mentors for each aspect of your company. They can help you make a better business plan, tackle in more depth your revenue model, and even think about the marketing channels that fit your projects. Incubators usually provide you with working space, where you will find all the necessary resources to carry on your projects in the best environment. A major difference between incubators and accelerators could be the stage at which a startup is at. While incubators will help you bring your project to life, accelerators, on the other hand, will take you from a small-size company to a big one. And finally, government aids. Nowadays, governments clearly see the benefits of having an ecosystem of startups in their countries. Most governments have allocated a budget dedicated to financing new companies. You might want to check your government website to find out any financing program they might have, whether or not your company is eligible, then apply. The following model is what we believe works best for starting a company and taking it to the next level. Step 1. Invest some personal savings into the project to create an MVP or a minimal viable product. Step 2. Show your MVP along with a business plan to investment angels or go straight to an incubator. The incubator will help you structure your company and get your first clients. Step 3. Once your business model is proven viable, you can go ahead and consult a venture capital for larger investment. Now that we have covered different sources of financing, you should be able to spot which channel works best for you. If you're interested in one of the channels we have covered in particular, comment below which one, and we will make sure to post a dedicated video to dive into it. We will also put together explicit and actionable steps for you to start immediately. We hope this video was insightful and informative. For more videos, don't forget to like and subscribe to our channel to support us and be notified when more videos come out.